Hello, everyone. Welcome to the Climate Policy Acceleration Forecasting the Investment Landscape to 2030 in partnership with the Inevitable Policy Response session. We're very glad to have you here with us today. We would like to start by thanking our sponsors, JP Morgan, Credit Suisse, Ping An, Moody's ESG Solutions, Luxembourg Green Exchange, Citi, Refinitiv, BNP Paribas, IHS Markit, Alliance Bernstein, FSD Africa, Inter-American Development Bank, ICMA, Mizuho, IFC, and Ashurst. And before we start, just a few important reminders. Please use the Q&A box to ask questions, other comments or queries to the chat. We have live interpretation in Portuguese, Spanish, Mandarin, French, and Japanese today. Look for the headphone icon to change that. All sessions are being recorded and you can listen to them until November in Swapcard. And use the cool tools on offer to network with thousands of attendees and check out our virtual booths. And for media interviews, visit the Climate Bonds virtual booth to arrange. Many thanks for your presence and enjoy. And now over to you, Thomas, to introduce our amazing speakers.
Thank you. Hi, welcome everyone. Very excited to have our 60 minutes together now in the plenary on the Climate Policy Acceleration Forecasting the Investment Landscape to 2030. Just for a brief background, I'm Thomas Kansy, Director at Vivid Economics, a McKinsey company, and part of the Climate Policy Forecasting Consortium behind the Inevitable Policy Response. I'm incredibly thrilled to have three fantastic investor voices with us today to share their insights on how this acceleration plays out, how can we prepare for this, as well as the risks that those that are not preparing for them face. First, we have Maria Fasakova here. She's a Senior Director and Head of UK Regulated Utilities for Fitch Ratings. Hi, Maria.
Hi, everyone. I'm really pleased to be part of this panel today.
Fantastic. Second, we have Radha Kupali. She's Managing Director and Impact and Advocacy for New Forests, a fantastic asset manager. Radha, welcome to the panel.
Thanks for having me, Thomas.
And last but not least, we have Sakarika Chatterjee. She's the Director of Climate Change for the Principles for Responsible Investment, also part of the Climate Policy Forecasting Consortium, and of course, a COP26 high-level climate action champion. They're part of the team behind that. Welcome, Sagarika.
Thank you.
Perfect. Thanks, everyone. So in our All Together, we really aim to have a lively discussion, including an audience Q&A at the end, on the overall, what is happening to the policy acceleration. First and foremost, to set the scene, within the Inevitable Policy Response, there is a forecast provided for investors on this coming acceleration that we see in international and domestic climate policies. It's covering the full economy, including also carbon pricing, energy, land use, and just conditions considerations with this. We'll dive deeper into those particular aspects later. It is also based on what we see, namely the multiplying pressures for governments to really act more decisively than they have so far. That is not only based against the backdrop of the global stocktake, but what we've also seen in the recent IPCC report, calling it a code red for humanity. So now it is really about how do we, as investors, reassess our investment beliefs? How do we prepare our portfolios against growing climate-related risks? How do we also seize many of those green opportunities? So in these sessions, our distinguished investors will have their voices on discussing the big calls to be made and the big risks that also face those that really are the slow movers. And so we'll dive very, very deep into all of these parts. But let me start with you, Sagarika, on the COP26. You're, of course, closely involved with both regional, with global investors in many countries through the Principles for Responsible Investment, and of course, in your role as a finance colleague for COP26. What do you see? Is the climate policy momentum accelerating? Are investors seeing more signals from policymakers in the run-up to Glasgow? What's the state of what's the lay of the land?
Yeah, thanks very much, Thomas. So there is momentum, but it is not enough. And I think I'll just take a step back and go to, how do we think stakeholders are going to judge what success is at COP26? And I think the first thing that stakeholders are going to look at are near-term targets with a focus on what's needed by 2030 for business, for investors. That means really thinking about the next 9 years. But when we look around, we see, increasing carbon neutrality ambition in the UK, EU, Japan, US, and China. And we also see more in terms of financial regulation on climate disclosure, taxonomy, but there still isn't enough, particularly, as we all know, in China. So that's a very open question in terms of how could ambition be increased. I think the second area where we'll be looking for success and where stakeholders will judge it is on how are we achieving the breakthrough actions that are needed in every sector for a pathway to net zero, and how far off are we? So that's where I think the IPR analysis is increasingly valuable, because it gives us a sense of where are we, and actually engages with the detail of what that means. Then I think the third area where stakeholders will be particularly scrutinizing governments is on mobilizing capital. So not just the 100 billion that's needed for developing countries, and not just the question of did we get the right people to COP, were the vaccinations, the funding for the quarantine, was that adequate? But how are we actually mobilizing the trillions that's needed for transition, and not just in terms of mitigation, but also resilience for 4 billion of the world's most vulnerable people. And then the other area, obviously, where civil society will be very active is fossil fuel phase out. Have we really succeeded in consigning coal to history? Thomas, I want to briefly mention, just because it has to dip down to a country level, a couple of more positive developments. So particularly I wanted to highlight in terms of momentum, China, the NDRC's pilot scheme for green power trading. In Japan, the basic energy plan does look to increase renewable energy, but again, we need to see coal phase out tackled. And then in the US, a really interesting time right now for everyone active in this space to be monitoring. We've got a once in a decade opportunity with the US reconciliation budget vote that is due in a matter of weeks. And that is very important. We need to see members of Congress pass budget legislation that makes climate absolutely embedded within every committee's jurisdiction and bold action. That would include a fully funded clean energy standard or payment program with incentives and penalties for utilities to scale up clean energy, a 10-year extension of existing clean energy tax credits. The list goes on and on. If, as a finance actor, you're not yet active and seeking to use your political influence, particularly on the US reconciliation budget, we really encourage you to do so. This is a kind of policy engagement that brings to life whether or not near-term actions are taken and what's actually delivered at COP26. Thanks, Thomas.
Thank you very much, Sagarika. And it's fantastic to hear the highlighting about all the clean energy investments that you've already highlighted on the domestic level. Maria, with those wide sweeping changes from a ratings agency perspective, do you think the finance sector is still in front of the policymakers? And does the delayed COP26 provide the opportunity for the first round of a big policy catch-up as well? What is your view on this?
Yes. So COP26 certainly provides opportunity for policy catch-up. And as Sagarika has mentioned, a policy has been accelerating across the world, with now around 60 countries pledging to become net zero neutral by 2050. And European Union clearly leads the way to net zero for the world, with its recent announcement for Fit for 55 plan, offering quite strong near-term pledges to decarbonize hard-to-abate sectors, including industries like cement, aluminium, metals, power sector, and of course, proposing very controversial carbon border adjustment mechanisms. We can only hope that the rest of the world will follow suit in its ambition to decarbonize and accelerate the transition. As for the investors being ahead of the policymakers, this is only partially true. Well, by now everyone understands that the world is serious about tackling climate change, and everyone understands that the economic value will inevitably shift from the carbon-intensive industries to the cleaner ones. No one really knows when this will happen and exactly how much value will shift. So for investors, it's quite important to have those policy decisions which provide much greater visibility over the timing of the economic impact. And so that will serve for better decision making.
Fantastic. Maria, would you mind shedding a bit more light on how you think about the likelihoods, and when you look at the ratings from a ratings agent's perspective and the scenarios and the exactly the timing, as you already mentioned?
Yeah, so if we look from a rating agency perspective, we are, we have developed a pilot product based on the UNPRI scenarios, which are looking at the vulnerability of the bonds and effectively credit investors out to 2050. So looking at longer term policy scenarios and responses. We do see, for example, in the power sector that coal industry will be losing its value, and it really differs by geography. So we believe that in Asia that will happen later, and in Europe it will happen earlier, and in the US it's nearly happening now. We see sectors that are shielded from this, sort of maybe asset deterioration or value devaluation, such as renewable sectors or networks. And also we see some of the newer technologies getting greater traction, including the battery storage and hydrogen, and other, flexibility, system flexibility technologies.
Thanks, Maria. That's very insightful. Slightly switching, given that we've heard a lot now about energy and industry and what is happening in transport. Now, when we look at another sector that is critical to the climate transition overall, and not only provides climate benefits, but other socioeconomic benefits and environmental benefits, land use. Among what we do in the IPR forecast for investors, what we do out to 2030 is that there's a much greater role in emissions reductions stemming from land use and agriculture. This includes re- and afforestation and forest protection activities, and including better agricultural practices. So we're seeing really more references also generally to the importance of land use in reaching global emissions targets. Radha, this is your specialty. Policymakers, they're talking more and more about land use in some of the countries in particular, but it's also, it's big, it's complex. What's your view? What will accelerate action in this sector?
Thanks, Thomas. And I think it's one of the real credit to the IPR that it does have such a significant focus on land use. Land use is, important to not only addressing about 23% of current global greenhouse gas emissions, but land use is also going to remove about a generation's worth of emissions out of the atmosphere. So it's critical. All credible pathways to net zero have to address land use. And I think the policy acceleration is already happening. So I'm sitting here in Sydney, Australia, where there's increasing pressure on the government to adopt a net zero target. And today already about 70% of the emissions reductions activities that are being financed in Australia are coming from nature-based solutions. And the government's already looking at how to accelerate that, introduce more methodologies. Just across what we call across the ditch in New Zealand, the carbon price is already going up to $70 Kiwi, and you see a lot more investment going into reforestation, ecosystem restoration. And similarly in the United States, California also already has a significant emissions trading system that has financed climate mitigation across forests in the US. And now the Biden administration is looking more broadly at how to accelerate that across the United States. But I think the IPR forecasts this quite well, that we are going to see this acceleration in developed countries But ultimately, I think the challenge, Thomas, is that most of the reforestation and the conservation needs to happen in emerging markets. And we need an international policy framework that's going to facilitate that kind of investment. So this COP26 is really important to address Article 6, which is all around the trading framework. And we need essentially a good framework around voluntary carbon markets as well. So there is a lot of work ahead of us for emerging markets.
Thanks, Rada. And yes, absolutely. As you know, as part of the IPR forecast, there is the 2030 ban on rainforest clearance and also the emergence of really large-scale and afforestation projects and multiple nations, not only, as you already highlighted, in developed countries. So there will have to come a global policy agenda in the next few years for this, as well as to really help us meet global emissions targets in the first place. What are the biggest barriers that you think investors face on this to really allocate increasing capital to sustainable agriculture and land use projects?
Yeah, I think there's probably three key ones that we see through our experience of working with investors. The first is essentially the size of the investable universe. You know, today, sort of forestry, timberland is about a $200 billion asset class. Well, really, this needs to move to be a $1 trillion asset class, and you know, to really make this a large institutional scale asset class, we need the underlying carbon pricing and the economic signals and the policy signals that will really start to pull money into forest conservation and restoration. And as I was just mentioning briefly earlier, you know, where we do have those policy elements in Australia, New Zealand, elsewhere, the capital is flowing, and we are seeing that direct economic impact in that underlying land use. The second thing is that you know, we need actually the accounting frameworks, the impact frameworks. So essentially that you can compare and you know, different kinds of asset classes and fundamentally see that forestry is a climate solutions asset class, or agriculture can be a climate solutions asset class. And so there is a huge amount of work being done right now. I think the next kind of 12 to 24 months is really critical around kind of biogenic removals and getting the accounting framework in place. But ultimately, the biggest stumbling block is that much of the capital deployment needs to go into emerging markets. You know, we need probably something like on the order of 500 million to 750 million hectares of reforestation, you know, over the next decade. And that is hugely complex from a investment perspective, policy perspective, working with communities on the ground. And so really what this is going to require from investors is to bring innovation into strategic asset allocation, rethink you know, how they think about risk in the context of climate, and also look at innovation around, you know, blended finance structures, impact investment, and how do we actually bring multiple types of capital to bear on this problem of delivering capital into emerging markets.
Indeed, Rada. I mean, Sagarika, with your high-level climate action champions, I mean, that's exactly the question. How do we get the north-south capital flowing? And picking up on your earlier point, how do we go from billions to trillions? It's, of course, one of the really key aspects of the SDGs as well. So what do you see at the moment at big international forums like COP or the G7 and G20? What is the ability to respond at the moment, and what's the outlook for that?
Yeah, I think it's fair to say there hasn't been enough action. And what we are going to see at COP26 is this is going to be a big agenda item. So both the public finance as well as the role of private finance. I'm not an expert in this area, but what I have heard are some of these points, which is firstly, we need to tackle both the mitigation and resilience, including, for example, resilience of small island states, for example, in the Caribbean. That's a real challenge in terms of the investment case that there is. So that's one that we'll really have to crack. I think the other thing that finance players tell me is that they need to see multilateral development banks and development finance institutions step up in terms of the role they play, how much attention they give to this, and the de-risking in order that we can unlock both the public and private finance. On the positive side, there's three things that I've seen bubbling away that I think are interesting. Could they be built on a bit more? So the first is the Climate Finance Leadership Initiative, objective. So they have a pilot, for example, in India, which you may be familiar with already. India, 7% of the world's greenhouse gas emissions, set a goal of 450 gigawatts renewable energy capacity, and there's a $650 billion investment opportunity, according to BNEF, across generation, storage and grid infrastructure. So Climate Finance Leadership Initiative is working on a pilot in India to look at how can that attract private capital. They haven't got the answers yet, but that kind of collaboration, I think, is much needed. The second interesting development that you've probably seen is that BlackRock secured $250 million from investors and governments for clean energy uptake and climate infrastructure across Asia, Latin America and Africa. That's through the Climate Finance Partnership, and it involves few investors and banks such as Daiichi from Japan, Standard Chartered, as well as the French Development Agency, and they're looking to generate about $500 million. So let's see what innovation and delivery comes through that. And then finally, from the PRI signatory base, we've got a group of asset owners called the UN-convened Net Zero Asset Owner Alliance. They're looking at blended finance, but not just at what could they do, what do they need the DFIs to move on, and what are their recommendations back to DFIs so that they can scale up and meet their investment objectives. So a ripe area for a lot more innovation and some tough challenges to crack.
Thanks, Sagarika. One of the things that we also wanted to dive a bit deeper is specific policies underlying this, with carbon pricing in particular driving a lot of the financial flows as well. Now we've seen carbon pricing and also carbon border tariffs increasingly being discussed by policymakers. China launched its national ETS, Maria, as you already said, in the Fit for 55 package by the European Union. We have the carbon border adjustment mechanism, and overall as well, as part of the IPR forecast, continued growth in different forms of carbon pricing all the way to 2030, both in scope, in starting carbon pricing, and the ambition of this. Maria, you're a specialist in all things EU, of course. So what's the impact that you think the EU carbon border adjustment mechanism had already? And do you see any wider international implications stemming from it?
Yes, sure. So maybe first, just a very quick recap what carbon border adjustment mechanism, or CBAM, is designed to do. It's designed to replace free carbon allowances for the power sector and energy-intensive industries, and the sectors such as cement, steel, aluminium, oil refinery, chemicals, fertilizers. And effectively, it will work alongside the emission trading scheme. The planned introduction date is 2026, but it is still only a proposal by the European Commission. It may take some time for the European Union to put this in legislation. It may take a few months or a few years. It's certainly a very sensitive political topic, because it prevents carbon leakage and protects EU industries, but at the same time, it almost imposes a tax on the exporters. So countries that are exporting CBAM products to the European Union will be subject to a carbon-related charge, which will be calculated as the ETS carbon price in the European Union, net of any free allowances and net of any carbon costs incurred in the countries of production. So this mechanism effectively targets two goals. As I said, it protects EU domestic industry, but also incentivizes other countries to introduce their own emission trading schemes, and basically advance the net zero. If you are an exporting country, you might think, why should I let European Union tax my industry and keep the revenue when I can do it myself? And so this is quite a significant incentive for the countries that are exporting to European Union to introduce their own schemes for either carbon pricing, emission trading schemes, or carbon floor, or any taxes. So in terms of countries that are most exposed to the CBAM, these are Russia, Turkey, UK, China, South Korea, Ukraine, and these countries undoubtedly may suffer an increase in the costs for those industries that are exporting to European Union from 2026. However, it will not happen immediately because the free allowances for those high emitting sectors are being phased out between 2026 and 2035 onwards. So countries have some time to adjust until this hits those producers. This certainly should be considered by investors. There is opposition against this mechanism. Currently, political opposition from China, from Russia. We are yet to see where this will end up, and arguably there are different policy responses actually, maybe achieving the same kind of objective. And from the overall global climate perspective, if we think about the carbon border adjustment mechanism, it's not the most efficient mechanism because the carbon embedded in trade flows is typically amounting to around 10% of a country's total emissions. So it doesn't really tackle all of the internal emissions inside the country. Ultimately we're yet to see how this will impact the rest of the world outside Europe, and we need to see in which shape this mechanism will be effectively introduced in 2026.
Thank you very much, Maria. I hear your slight skepticism about the posturing, at the very least at the moment, regarding other countries' responses to a carbon border adjustment mechanism. What is the right way then for investors to actually consider this, given that, as you already said, some of the countries are pushing back against and introducing carbon pricing, and yet when we consider the IPR forecast, in the IPR forecast, there is an extension of carbon pricing out to 2030. Of course, with differential carbon pricing bands, higher and lower, depending on how ambitious the country is overall, but a general expansion. So how do you think, what should investors actually monitor to gauge any risks as well as opportunities that stem from the carbon border adjustment mechanism?
So I guess investors should be monitoring policies, any big policy decisions on the national level. There is now general consensus in the world that the cost of decarbonization per country should be proportionate to the size of a problem or proportionate to how much a country contributes to the global emissions. And of course, if we look out to 2030, it's four economies, really, European Union, United States, China and India, that will contribute over 2/3 to the global emissions. So we should be expecting more to be done by those economies. Now, the way the emission trading schemes work is that they set a maximum level of carbon permittable within the country during a period. And that allows the industries that are high emitters to buy CO2 from the industries that are low emitters, and that drives the market price of carbon internally in any given country. So effectively, the carbon price in any given country, if the emission trading schemes will be introduced, will really depend on the ambitiousness of the targets to decarbonize, on how much the country needs to do and how quickly. So we may well see differential in the carbon pricing. In fact, if we look at the proposal by the IMF has proposed the carbon price floor instead of any emissions trading schemes or any carbon border adjustment mechanisms, stating that a carbon floor is a more flexible policy mechanism where every country can decide what is affordable and complement it with carbon taxes.
Wonderful. Thank you very much, Maria. Radha, I'm sure carbon pricing, especially also then in the land use and agricultural sector, plays a big role. How do you see the growth of carbon pricing develop in this sector as well as then globally? bridging from your response about developing nations already being further ahead?
Yeah, there's a few trends that I think we're seeing, and I think will continue to accelerate. I mean, certainly in the developed market context, we've seen steady price rise. Again, looking at Australia and New Zealand, just even in the past 2-3 months, prices are steadily going up, rising 10-15%, just in a few months. So I think that the carbon price will probably track what's coming out of these IPR forecasts, where by the end of the decade we may be around $50, $60, $70 per ton. Given, I think that's a reasonable expectation given where things are at now, sitting here in 2021. And again, as Maria says, that will be closely tracking what is the ambition of the countries and the policies that are put in place. In the voluntary market, which is largely supporting, land use projects in emerging markets, we've largely been stuck these last few years around $2, $3, $4 a ton. We've had kind of a hangover from the Kyoto Protocol days and these kind of low cost of CDM credits. But I think it's not necessarily happening fast enough, but there is this recognition that, you pay for what you get. And so if we do want to have projects with biodiversity benefits, community engagement, kind of a very professional management approach, we deal with permanence issues, prices are going to have to be higher, particularly if we want things like reforestation, restoration. So you're even starting to see kind of a differential in the voluntary carbon markets for some of these higher quality projects, where the price is now starting to climb up to $8, $9, $10, $15 per ton of carbon. And if we can get, again, kind of the policy frameworks correct, I do think that those prices will start to accelerate as well over the next 5 years. So I think it's sensible to think that there'll be this kind of differential between kind of developed markets and emerging markets. But if we can get the policies and frameworks in the right place, I think the upward trajectories will be very similar.
Sagarika, what do you think about carbon pricing, and also as a bit of a channel to help unlock the trillions and allocate them across the globe?
Yeah, so the feedback we get from PRI signatories around the world is that this is the #1 topic that they always have and want to be advocating on, and find it hard to understand why things haven't moved after such clear signals that they've given. And I think the two things that are really interesting to me about the IPR 2021 forecast policies. So the first is this idea that there may be a EU, US, China carbon club in the 2020s. And the second, I think, around the US national carbon pricing being in place as early as 2023, and by 2025, and I think you put the number at roughly $65 by 2030. So actually, I wanted to throw it back to you, Thomas, and say, because I think it's potentially controversial. What was the rationale a bit, I guess, for the thinking on that?
Yes, absolutely. So, Sarika, you rightly point out that it's coming from the Carbon Club. It's coming from the conversation about carbon border adjustment mechanisms. In the first IPR forecast that came out in 2019, that was one of the things that we said will happen earlier than later, that we have a carbon border adjustment mechanism. And then, of course, the IPR forecast was correct on this, and actually earlier than expected. And so this is the continued driver behind it, recognizing that, of course, in the US, there's various issues about federal policies versus states and others, but at the same time also noting the Biden administration's comments on carbon border adjustment mechanisms in the first place. And it is a free market response, essentially, to this, helping find the right price and equalize and level the playing fields between countries as well. So it is, in a way, positive for trade, equal and free trade on this, and it is pulling the weight, essentially, of this. And so, yes, there's some of the big calls that the IPR policy forecast put out, and the US federal carbon price is exactly that one. At the same time, we also see that the voluntary carbon markets are surging, and we see all the initiatives around this. And carbon pricing, of course, provides one of the main channels to provide that funding and allocate this funding, raise it from developing countries and the high emitters, and channel it to rainforest countries for protection and other social benefits. So yes, indeed, the IPR policy forecast is very positive on carbon pricing and the level of it. But at the same time, when we look at, we had Canada as one of the leaders on this, and recently, this has been ruled constitutional, and the policy forecast that we have is even lower. So I'll tell you a bit more about at the end, but we're reissuing the policy forecast with changes in ambition, recognizing what has happened over the last 6 months since the last forecast.
Thomas, if I could just continue this conversation a little bit, and Radha had also, mentioned the voluntary carbon market. So this has been controversial with civil society. What could you just clarify? What are the sources of the controversy, and can this all get nailed over the coming months? Because it's clear that we're going to need voluntary carbon markets.
So, Sagarika, I think that this is an excellent question for everyone on this panel, essentially. Also for the high-level COP championship, you've seen a lot of the civil society coming into this, and while applauding the ambition of voluntary carbon markets, having the focus remain on reducing emissions first and foremost. And there is the recognition as well that even when we are reducing, we are basically overshooting temperature targets, and we're emitting more than the carbon budget itself. And so there needs to be a mechanism to some extent to remove carbon later on. And voluntary carbon markets can provide one of those mechanisms as well, in particular on nature-based solutions, and not only remove carbon, but provide various co-benefits. And I almost regret calling them co-benefits because they're really main benefits. But Radha, please tell us more about this, because that's your special.
It may be worth just giving a little bit of historical perspective here, because this actually relates to the carbon border adjustment mechanisms. If we go back to the days of the UNFCCC, the Rio Summit, the development of the Kyoto Protocol, this is the days of globalization. So the idea was, right, that we would have one global carbon market with targets distributed among all the developed countries. And so there would be one global carbon price, and then you had some offset projects through the CDM and the Joint Implementation Mechanism. And so the voluntary carbon market was this little small thing that was basically enabling companies that wanted to go carbon neutral to offset, their supply chain or their operations to do that. And so it was this kind of tangential thing. But what's happened, right, over the last 20 years is that the Kyoto Protocol broke down. We now have a Paris Agreement approach where everyone is taking their own approach. And so the voluntary carbon market is now kind of stepping in to fill this kind of policy vacuum. And so that is the fundamental challenge, is that we've got corporate ambition and civil society ambition kind of traveling ahead of where countries are at, and not having one, kind of global market. And so there are very legitimate concerns around ensuring that, we have science-based targets, we have credible pathways to net zero amongst companies, particularly in the absence of, cap and trade systems and regulated emissions caps. So we do need voluntary carbon markets because of the policy vacuum, the unfortunate policy vacuum. But we can't make it so difficult for companies to use those mechanisms that we end up just prolonging the transition. And I think that is the fundamental issue that we need to work out, because we're going to have more bang for our buck ultimately if we're able to trade, be able to have capital flow to land use, and have some flexibility. So I think there's a lot of attention being paid to this now over the next 2-3 years. Some of the big philanthropic donors are focused on this. So I'm hopeful that we'll try to come to some landing and try to be a bit practical rather than dogmatic around how these markets work while we're getting the policy framework right. So it's going to be a messy and challenging time, but it's going to require everyone to try to see the greater good over the next 10 years.
Indeed, it will be definitely a challenging time. Rana, just a very quick follow-up question. What do you think then, beyond Maria's point already about monitoring the policy in the latest development, how can investors actually prepare themselves for this market, given that it is so turbulent at the moment?
Yeah, look, I mean, from a New Forest perspective, right? I mean, and the uncertainty around carbon pricing, you know, ultimately we have to be thinking about what are the investment strategies that manage risk while also prepare us for the future. So, you know, we have a real asset strategy. So we're investing in the underlying forestry assets, land assets, and have a underlying exposure to sustainable production, which will continue to have value, you know, into the future. And by having exposure to the underlying land assets and forest assets, that gives us optionality as the policies firms up, you know, carbon pricing firms up, to start thinking about how are we managing these assets for climate mitigation, sustainable production, the emergence of a bioeconomy. And I think those are the strategies that investors need to be thinking about, is how do you start to position your allocations, the different kinds of investment strategies that you have to try and take advantage of the new and emerging opportunities. And, you know, ultimately that requires some innovation. It requires some risk taking. I think Sagarika is completely spot on with the discussion around, you know, DFI stepping up and thinking about blended finance. It's actually going to require acting in a different way and investing in a different way. And I think that's one of the, that's really what needs to be happening right now, is that kind of experimentation while the policy environment frames up.
Indeed. Thank you very much, Rada. And taking us one step back, I realize COP26, voluntary carbon markets, these are very imminent, very palpable movements that investors, of course, are very closely monitoring. At the same time, in the inevitable policy response, the timing, and Maria, you mentioned this already in the beginning, the timing is centered around a longer term outlook. It is not only the IPCC reports that really highlight the cost of insufficient action, but then also the global Stocktake that is scheduled for in a couple of years in 2023, in a way demonstrating already insufficient action, and then leading towards the nationally determined contributions revisions and the new target setting by governments, really stepping up the commitment to more action in the end. And this is one of the central drivers of the timeline itself, as well as the new policy action itself. Now, when we look at investors in a way, are we in the first place, is the inevitable policy response correct that looking ahead at these events, the UNFCCC process, the showing of insufficient action, as well as then the new government commitments, are these the correct anchors to think about global policymaking and the next wave of commitments? Maria, you already mentioned many about the skepticism that we have heard from some of the countries, but what do you think about the global picture of it?
Yes, absolutely. So we believe, Fitch believes that the inevitable policy responses and the scenarios it developed are quite credible in terms of, you know, forecasting what needs to be done to deliver, you know, 2% global warming or 1.5 scenarios. And certainly this helps a lot investors in terms of forecasting longer term, because as we've discussed, the policies may lag a little bit and it's political and it takes time to make those decisions. But as long as we understand what generally needs to be done, what generally needs to happen in the sectors, what sort of carbon price we are looking out to achieve those net zero targets, that gives, you know, those forecasts give credible scenarios to us as a rating agency, and allows to interpret these scenarios for the purpose of investors, to demonstrate how the value will migrate, where we may see stranded assets towards 2050, where we may see new value being created. We were talking about new technologies in the power sector, you know, including hydrogen, for example, which is still not economical, batteries, which are still not economical, carbon capture and storage. And we know that the policy support is lagging behind. We've seen some support for these technologies, some initial proposals to support prices and volumes, make it a bit more investable, but it is difficult to foresee now. But when we take into account longer term horizon out to 2050, that is becoming quite clear that one way or another, the world will have to move towards that direction. So investors investing in longer terms bonds, into debt markets for 20 years or 30 years, certainly have to take into consideration the impact that all of those policy scenarios will have, independently of where the policies are at the moment.
Thank you, Maria. Sagarika, what do you hear from your members? What is the usefulness of doing this policy forecast and how to implement this?
Yeah, sure. Really a great question. So, what we find that PRI signatories find particularly useful is the granular thinking about how are we going to get there, going at this from both a policy forecast thematic level, as well as I think at the country level, and the fact that this covers all asset classes, and it can be useful to so many different kind of roles within an investment firm, say portfolio manager, head of sustainability or responsible investment, CIO level. This can be extremely useful to both engage them at a kind of a strategic level on are they taking enough action on climate and really thinking about what they do, as well as at a kind of an investment analysis level and giving a kind of credible, robust analysis. So one of your questions was around the Stocktake and how critical it will be. The Stocktake will be important. The 2025 government pledges or NDCs that are submitted will be very important. Where I think IPR again adds the value here is thinking through the now to 2025, thinking through the 2025 to 2030, and then what we'll need to turn our minds to is the 2030 to 2035 and longer time frame, covering every time horizon there is between now and 2050. And so I hope that this analysis will continue to be useful across the different markets that PRI operates in for the different types of investors that we have.
Radha, as one of the actual users in the end of this, what is your view on the long term and the anchoring around the time frame?
I mean, in terms of the Ratchet itself and that question, I guess the thing that's really central to my mind is, what happens in the U.S. We've got midterm elections coming in 2022. We have to see what's happening with the Biden administration. I think that's just going to be so critically important to being able to continue this, agenda around climate. So that's probably one of the things that we're, looking at very, very closely in terms of, where the policy actually heads. One of the things I find very useful about looking at the IPR is not just the underlying land use piece and what's going to happen with deforestation and restoration, but ultimately also what is happening in food systems and food technology and that transition. Because ultimately, if we can start to take land out of agricultural production, out of grazing, out of pasture land, that ultimately, because of new technology, the transition to plant-based diets or new types of technologies in terms of meat production, that's ultimately going to drive down the pressures on deforestation in different parts of the world. So getting that kind of modeling that looks at, what's the other part of this equation that's going to impact the land use side is incredibly useful. And it's been helpful to be thinking about, from a modeling perspective, what are the price trajectories that we might be looking at in different parts of the world.
Yeah, and Thomas, I should just add that before the inevitable policy response, POI had done a lot of work on kind of deforestation, sustainable commodities, but we didn't have the granular enough analysis to really try to engage the POI signatories on land use and to help them join the dots between their climate actions and what they're taking and nature, biodiversity, land use. So it's been phenomenally helpful in that regard, whether you're an investor that is a kind of a stress tester, an aligner, or a kind of a forecaster.
I agree, Sagarika, because this is the issue, right? I think the transitions that are required in, energy, transport, manufacturing, all pretty well understood, like what's the pathway, but the land use sector is just so complex. And I think for investors to kind of wrap their heads around, what are the key levers? What are the key transitions? How can we get there? It's a really important discussion to be having.
Indeed, and I think one of the things that the feedback might also be about the systems view of it, as Sagarika highlighted. It's not only necessarily the granularity, but the inevitable policy response also aims to give a consistent view across this, and also how land, energy, electricity, transport, industry interacts with each other. Now, thinking of this broader interaction, essentially. And opening up to everyone on this, really. What should asset managers really do? Should they, asset managers and owners, should they try to stay ahead and make those bigger calls sooner, change their portfolios on energy, land use, sustainable infrastructure, and move towards corporates towards the transition itself? And if they should, how should they go about this? Radha, if we start with you on this, what should asset managers and owners really do?
Yeah, I mean, I might be maybe repeating myself a little bit from before, but I think it's from a land use perspective, certainly that's ultimately where we're going to see land use competition, and we're already starting to see it in places where there is underlying, carbon pricing. We're starting to see rising demand for land, for agricultural commodity production, for forestry, for climate mitigation, bioenergy. And so from an investor perspective, there has to be some directional bets around, what direction is this going in? And so how do I need to position my portfolio for that, that changing world? And it is going to require those kind of directional bets. And as I was saying before, it's going to also require innovation, thinking about how to invest in emerging markets, thinking about blended finance, new investment structures, ways of managing risk. That's all going to be really critical, I think, in terms of land use and agricultural and forestry.
Thank you, Radha. And speaking of exactly those risks, Sagarika highlighted in the beginning the great policy action that we already see in China, in Japan, and of course, the potential with the US reconciliation budget. Maria, on a ratings perspective, what do you think asset managers and owners now need to do to receive a good rating, essentially, and mitigate those risks?
Yes, so I guess from our perspective, from a corporate perspective, and looking at the bonds of the corporates and how the debt is being traded, we really ought to not to forget what's the investment horizon that asset managers have and how far away they are looking at, and whether they need to make some longer term directional decisions on the different asset classes. And for some of those, it's quite difficult decisions that that the investors need to make. So if I make an example of the power sector, we understand that gas will be a transitional transition of fuel for this very kind of strange and uncertain period between when the power systems are still not clean towards when they are majority renewables and carbon free, right? So we need 10 years of gas, and we need 10 years of or maybe longer of nuclear. And here I think that there are big question marks here, because we ultimately know that the fate of gas probably out to 2050 is not going to play a major role in the power systems. But how exactly and how quickly this will phase out, I think that these are just really the bets that every country will have to make their own decisions, and the same happens with nuclear. So it boils really down to regional policy responses, as we discussed in the beginning.
Perfect. And Sagarika, from your side, for your signatories, for in general asset managers and asset owners, how to prepare for this?
Sure. And I think I come back to one of the first messages that we had with IPR, which is act now. And I think that means two things. The first is that obviously we really encourage alignment with TCFD and implementation. This will help you in TCFD implementation, particularly, I'm going to get a bit technical, but around these strategy governance kind of indicators, i.e. your strategic thinking about climate risk. And then the second thing is thinking about your actual capital allocation in light of the IPR forecast policy scenario. And this is a high probability scenario, and the implications of that are, I guess, either you're going to believe it and take action accordingly, or you're going to have a really good internal discussion and do your own additional internal analysis, which is very, very welcome and much needed, and land in a different place. And that is also good because that will make a contribution to, I think, the finance industry dialogue that we need to have, both within financial institutions, but more broadly across the finance sector, on how do we think climate risk is going to play out and what are we doing in light of this in the near term.
Indeed, thank you very much, Sagarika. As one of the audience questions that we have coming in, beyond of course asking for a lot more information about the inevitable policy response, we just want to remind you is available on the Swapcard conference app and in contacts as well. So you can find all the information for this, and of course via the PRI's website. One of the big questions here is that, of course, Sagarika, you already highlighted it, it's trillions at the same time. And it is trillions that is infrastructure in a way. It's a lot of upfront investment, and it might not be the investments that you have incredibly high returns over a short period, but returns that stack up and build up over time. How do investors make that decision to forego some of the very short-term returns that might be promising in some of the higher carbon opportunities to help set the environment to scale up low carbon investment and commit this long-term patient capital? And it's a tough question, so to that audio members, touche, that was well done. Who wants to jump in first?
So I'll jump in first, and I'll probably tackle it at a macro level. So we need multi-year change, as we know, within the financial system. So PRI's had some work on a sustainable financial system underway for some time, and that looks at everything from the incentives in place through to investment consultants and how we get longer term thinking and thinking about externalities embedded into investment decisions. That won't change overnight. One thing that always does stick with me, though, is the comments that a long time ago AXA Group's former CEO, Amrita Kasturi, made, which was that, we can't ensure a future that is 3 degrees or 4 degrees. We just can't do that. And in the same way, we can't do that with our investments. It just doesn't make sense at all. So we are going to have to crack this one in terms of our investment objectives. And the other thing I would highlight is the increasing kind of prevalence of climate litigation that is happening for pension fund trustees around the world. So we will increasingly have to demonstrate we have been thinking about things with the right timeframes. And when we had the information, did we act on it?
Maria, please, you.
Yes, if I may take the next step and take it slightly lower level. So looking at again the power sector, for example. So we have technologies which need a lot of investment, a very considerable amount of investment, and it's very difficult to make that decision based on just thinking, oh, this is going to be the next big thing, right? So I think here we really come to the need for stronger policy support for those new technologies, taking hydrogen as an example, right? So we know European Union is scaling up its electrolyzer capacity. We know UK has introduced the hydrogen strategy, but what's more important is actually protecting investors from the perspective of the price risk. So making sure the price is predictable in the long term, but also the volume risk. So this is something that really helps overcoming those, longer term risks of asset stranding, for example, in a sector. And that's how renewables were, rolled out, 15 years ago. We've seen there were feed-in tariffs supporting those. So we do need a very targeted support into this.
Indeed, and thank you. We're coming, unfortunately, to the end of our time. It's been an incredibly engaging discussion. I wish we had more time for the audience questions and for further points. I want to thank you, Maria, Rada, Sagarika. It's been an absolute pleasure having you here. Thank you very much for your insights. Last but not least, I also want to advise everyone that we're launching the Inevitable Policy Response updated forecast for investors in October, given the acceleration of climate action and climate policy that we have seen since the last launch in March already. So thanks everyone again. Thanks Climate Bonds. Please stay tuned for the next session, the Green Window, Geopolitical Alignment on Climate between the Major Economies. That will start in a few moments. Thanks everyone.